John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hey there, this is John Ulzheimer. I am a consumer credit expert. I've got almost 30 years of experience in the credit industry. I've spent time at FICO, which is the company behind the FICO credit scoring system, and Equifax, which is one of the three generally recognized credit reporting agencies in the United States. And today I'm going to address consolidating student loans, specifically federal student loans. So these are federally guaranteed student loans. It's very, very likely that if you have these types of student loans that you have a cosigner, because a very large percentage of federal student loans have cosigners. I think I read somewhere that it's around 90%. So there's actually more than one person liable for your student loan debt. There's at least two people who are liable for the debt. So what is the benefit of consolidating student loan debt? And so I'm not referring to consolidating federal student loan debt with another federally guaranteed loan. I'm talking about refinancing or consolidating your student loan debt using some other form of consumer credit that is not federally guaranteed. And so specifically, this could be something like paying off your student loan debt with a home equity line of credit or HELOC, or paying off student loan debt with a personal loan, or otherwise refinancing the debt into some credit vehicle other than the original federally guaranteed student loan. And here's why. There's a couple reasons why that's a big deal. Number one is normally federally guaranteed student loans are not statutorily dischargeable, meaning that if you file bankruptcy, you can't just discharge your student loan debt under most conditions. And that's really a big deal, because you can file bankruptcy and discharge almost every other type of debt that you have, other than, say, like tax liens, but things like credit card debt, collections, all that stuff is dischargeable, meaning that the lender can get screwed, but the federal government can't, because that kind of debt is normally not subject to bankruptcy protection. So what occurs when you consolidate your student loans, and you probably have multiple student loans because student loans are reported to the credit bureaus on a disbursement by disbursement basis, meaning that if you go to school for 8 semesters and you take out a loan to pay for tuition for every semester, you've actually got 8 loans. And so that's going to show up on your credit report 8 times. So you have all these accounts that have balances, and obviously, credit scoring systems treat consumers who have multiple accounts with balances differently than consumers who have fewer accounts with balances. So from that perspective, it can be problematic to have so many student loans that have balances. When you consolidate, you're going to really accomplish 2 things. Number one is you're going to take all those loans and all of that debt, and you're going to kind of roll it into one loan. So instead of having multiple loans on your credit report with balances, now you're just going to have one. So that's an improvement, obviously, because now you have fewer accounts with balances than you did before. The second thing, and this is just as equally as relevant and important, is that you've now converted statutorily non-dischargeable debt to statutorily dischargeable debt, meaning that if the bottom falls out and you experience some sort of financial disaster in your life, then you can file bankruptcy and discharge the debt. So let's just say hypothetically that you take out a student loan, you take out a personal loan, and you pay off the student loan debt with your personal loan. You're still in debt, right? I mean, if you take out $5,000 to pay off $5,000, you still have $5,000 of debt, but you've converted the debt from being student loan debt to just basically a consumer debt. So you do have the ability to discharge it in bankruptcy at that point if you choose to do so. So there's also, with all pros, there are likely going to be some cons. And one of the cons is, so first off, your interest rate may not be as good with a new personal loan than it would be with what you're paying on your student loan, because interest rates on federally guaranteed student loans are usually pretty low. And so just be aware that you may be increasing your cost to service the debt if you were to refinance it. And clearly that's going to be something that's based on your credit quality. Number two is tax benefits. The interest on federally guaranteed student loan debts is tax deductible, meaning that you get a tax deduction based on the interest that you pay. Interest on personal loans is not tax deductible, so you don't enjoy that type of tax deduction. So before you do this, just be aware that there's some pros and there's some cons. If you do have someone who helps you with your taxes, it's probably not a bad idea to talk to that person and get an understanding of what exactly it's going to mean from a tax perspective versus just looking at it from a credit perspective. But still, it's an option. There's some pros and there could be some cons as well. So if you have any questions about this, just drop them in the comment section below. Thank you so much for watching and have a great day. We'll talk again soon.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.